Okay, let's unpack this. We are looking at arguably the most famous investor in history today, Warren Buffett.
Right, but we aren't looking at his stock picks.
No, not at all. We aren't breaking down Apple's latest earnings, and we definitely aren't talking about whatever crypto coin is trending on Twitter.
No, we're digging into the psychological architecture behind the man. It's what we're calling the billionaire mindset,
No.
but not the Instagram version with the private jets.
Yeah, exactly. We're talking about a specific behavioral stack, his absolute hatred of fast money, a very peculiar $1 habit, and a fundamental investing rule that, statistically speaking, 90% of people just flat out refuse to follow.
That statistic is the one that really gets me. I mean, everyone worships Buffett. Everyone wants his returns.
But when he tells us exactly what to do, 90% of us say, nah, I've got a better idea.
Exactly. So the mission for today's deep dive is to figure out why we ignore the advice and if we can actually replicate his psychology. It starts with this concept of fast money.
Because fast money feels good. Who doesn't want to double their money in a week?
Oh, for sure. That dopamine hit is the trap. But let's look at the mechanics of why he hates it. It's not just a moral stance.
Right, it's a mathematical one.
Yeah. Buffett treats money like an employee. So if you are constantly trading, buying, selling, chasing the next hot thing, you are constantly interrupting your employees' work.
You're triggering taxes.
Paying transaction fees.
Yeah.
But worst of all, you are breaking the chain of compounding.
So every time I sell a stock to jump into a new opportunity, I'm basically firing my best worker and hiring a rookie.
That is a great way to put it. Time is the friend of the wonderful business, but the enemy of the mediocre one. Fast money ignores time.
Which leads directly into that rule you mentioned,
Yeah.
the one everyone ignores.
Yes, the 90% rule.
So stop teasing us. What is the actual rule? Is it just buy low, sell high?
It's much more specific and honestly much more boring. Buffett has famously stated that for 90% of investors, and that includes you listening to this, the best strategy is to put 10% of cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund.
Wait, the world's greatest stock picker is telling us to just buy the whole haystack.
He is. He even put his money where his mouth was with the famous $1 million bet.
Oh, right, the bet with the hedge fund manager.
Yep. He bet that a simple, boring index fund would outperform a basket of high-fee smart hedge funds over 10 years.
And let me guess, the boring index fund won.
Crushed them. The hedge funds tried to be clever with fast money moves, while the index fund just sat there and compounded.
But here's the kicker. Even knowing this, most people won't do it.
Because it's boring. There's no cocktail party story in saying, I bought an index fund and waited 20 years.
Exactly, and that's the temperament gap. The rule isn't hard to understand, it's hard to stomach.
You have to watch your neighbor get rich on a lucky crypto trade and do absolutely nothing.
Which requires a psychological fortitude that most people simply don't have. Okay, speaking of psychological fortitude, let's talk about the $1 habit. We have this story in the stack about Buffett and his breakfast.
The McDonald's story.
Yeah, and I have to play devil's advocate here. Is this just a story about a billionaire being cheap? Because I don't see how saving 50 cents changes a billion-dollar portfolio.
It sounds trivial, I know. But the story goes that Buffett drives to McDonald's every morning. If the market is down, he spends $2.61 on 2 sausage patties.
And if it's up?
If the market is up, he splurges and spends $3.17 on a bacon, egg, and cheese.
So he lets the stock market dictate whether he gets bacon. That sounds miserable.
It does if you look at it as being cheap, but look at it through the lens of the billionaire mindset. It's about opportunity cost.
Meaning he doesn't see a dollar as a dollar.
Exactly. He sees a dollar as what it could become in 20 years if compounded at 20%.
Ah, okay. So when he saves 50 cents on breakfast, he's not saving 50 cents. In his head, he's keeping $500 invested.
It's an instinctive calculation of future value. Most people see money as utility. What can I buy now?
Right. Whereas Buffett sees money as capital. What can this earn later?
Exactly. The $1 habit isn't about the breakfast. It's a daily drill to remind himself that capital is precious and shouldn't be wasted.
Even in small amounts, it's like mental weightlifting. He's training his brain to respect the compound interest curve every single morning.
And that connects back to the fast money hatred. If you respect the seed, the single dollar, you won't gamble it away on a quick trade.
You treat it with the seriousness of a business owner. This really flips the script. We usually think billionaires take big risks and throw money around.
But the true mindset is actually hyper-conservative, hyper-patient, and weirdly obsessed with the price of sausage patties.
It's the paradox of wealth. The behaviors that get you rich are often the opposite of the behaviors people associate with being rich.
You have to be willing to be in the minority. You have to be willing to look uncool.
So to wrap this up, the secret is that there is no secret. It's rejecting the dopamine hit of fast money
Having the humility to just buy the index fund like Buffett suggests.
and viewing every single dollar as a seed for your future empire.
And realizing that the hardest part isn't the math. It's the discipline to sit on your hands when everyone else is running around.
Which brings us to the big question for you listening. We all say we want the results, but if 90% of investors ignore the rule because it's too boring, do you actually have the psychology to be the boring 10% that wins?
That's the trillion-dollar question.
Don't forget, like, comment, subscribe. Thanks for watching.